Not-for-Profit Financial Reporting, How to Convert Your Financial Statements to Meet the New Standard, was a live webinar that was originally produced on Thursday, June 28, 2018. For this webinar, we were joined by two of our team members here at McKonly Asbury, Janice Snyder and Jim Shellenberger. We hope you enjoy this recap, and please visit us online at www.macpas.com for more information about our future webinars and other events.
Great. Thank you, Dan. My name is Janice Snyder. I'm a partner here at McKonly Asbury. I lead our audit segment, and I work with a number of nonprofit organizations as well as healthcare organizations. We certainly have a lot to talk about today, and we will not be able to cover all of it during 50 minutes, but we do hope to give you a great overview of the new standard and how to convert your statements. And as you can see there, happiness comes in waves. I'm a little bit beach focused. I spent the weekend on the beach at Cape May and had a great time, and that's all I could think about, unlike Jim, who has other things on his mind.
Thanks, Janice. Jim Shellenberger, principal of McKonly Asbury. I was thinking back through it. I've been at the firm for 16 and a half years, and I think all 16 and a half have been working with nonprofits. So excited to be here. What I'm not excited about is the fact that the England-Belgium match just kicked off. I wait 4 years to see 3 matches, and one of them is the exact same time as this webinar is going on today. So if you are listening and you can send me score updates, I'd appreciate it. Maybe send me a text.
Come on, Jim.
through the question panel. That'd be awesome. I'll try not to get too distracted as that match is going on, but happy to be here and talk about financial statements of nonprofits.
Great. Thanks, Jim. So our agenda for today is we are going to spend about 15 minutes, so not too long. We have a full webinar on this from last year at this time about the requirements of the new ASU 2016-14. We're going to spend the bulk of our time, about 30 minutes, showing you how to convert a fairly simple set of financial statements, but sort of going page by page, schedule by schedule, showing you what it used to look like and what it will look like under the new standard. And then we're going to say some actions to take now, because if you really haven't done anything, you're getting to the point that it's getting close to too late, particularly if you're a 12/31/18 year end. And hopefully we have a few minutes at the end to take some questions. The next slide is our standard disclaimer. So we're not the FASB or the AICPA or anyone else that writes the standards, but we have read the standards. We attend their trainings, and I actually had the privilege of spending 4 hours in an AICPA training just on this new nonprofit standard. And we could not cover all of it. It was a lovely Sunday afternoon, just how I wanted to spend my 4 hours, but it was very informative. And even in 4 hours, we couldn't cover everything that's changing in detail. So the requirements of ASU 2016-14. So I'm going to kick us off. So this was released in the summer of 2016. So at this point, it's almost 2 years ago that we've been made aware of this. It's the most significant changes in over 2 decades, because our last one was written around 1993 when we came up with the current standards. And this is effective for fiscal years beginning after December 15, 2017. So for all you calendar year financial statements, 12/31/18, you are well into the period of adoption, 3/31 as well, and then 6/30/19 and 9/30/19. So you'll get through this year's audits, and you'll need to be focused on this. I can say the one CFO that was on the panel of a very large nonprofit organization said she had some aspirations of early adopting for their 6/30/18 year end, but when she started looking at this in January, she got very concerned that she had not prepared the board, the stakeholders, their banks for the changes that were coming, and actually became aware that she really wasn't able to early adopt as she originally intended. So hopefully we can get you thinking about some of this information, because it's here for those 12/31 year ends, and thinking ahead so you have time to prepare your stakeholders and your processes potentially.
Absolutely. I mean, it's hard for me not to talk. So as those of you that have worked with me know that I'm going to talk and interrupt Janice throughout this presentation.
I'm used to it, Jim.
Thanks. This project, this ASU 2016-14, is really the first part of a 2-phase project by the Nonprofit Advisory Committee of the FASB. What we're going to go through today is everything that's included in phase 1. The comment that I want to make very briefly is that there's a phase 2 that's coming down the road that's going to also impact nonprofit financial statements going forward. Things like measures of operations and other things along the cash flows. So more's coming.
Sure. So who does it affect now? The current standard that we're talking about, or phase one, as Jim said, it affects all nonprofits. So charities, foundations, churches, government organizations, healthcare providers, pretty much anything, 501c3s, 501c9s, 501c6s, anything that falls into those buckets. Yep. You need to adopt this new standard. So as they went through this, phase one, we'll call it, they really tried to say who uses these nonprofit financial statements and what are they really looking for? So this gets us to convert the face of the financials, and phase two will have us add a lot more information.
You hear very often, when respect to the 990, that's an opportunity for a not-for-profit organization to tell their story. This ASU is kind of gearing towards that as well. It's allowing a nonprofit, and we'll talk about that when we get into some of the disclosure requirements and examples around financial performance, liquidity, cash flows, really an opportunity for an organization to tell its story.
It's really interesting as we go through these 5 major changes. You think of telling the story, like Jim said, there's a lot of choices that you're going to be given, like functional expenses, presentations. There's 3 different ways you can do that. There's different ways to present the face of your balance sheet. So there are choices and options that the organization is going to have to make. So I'm going to walk us through the changes in net asset classification, going to bounce it to Jim to walk through some of the changes to your investments, come back to me for expenses, and then Jim will finish us out with the statement of cash flows and liquidity. Some of these are much more significant than others, so we'll just jump right in and spend our first 10 or 15 minutes telling you what's changed. So in terms of net asset classification, if you haven't heard by now, we're going from the 3 classifications you see there, unrestricted, temporarily restricted, and permanently restricted, to new categories, but only 2 now, without donor restriction and with donor restriction. So there's a lot of information that as you collapse that previously restricted category into with donor restrictions that you may or may not see on the face of your financials, but you're still going to need to be tracking all of these things. And you'll see that very clearly when we go through the examples. So I would say there's more information that's going to be disclosed, not less,
Absolutely.
Even though we're going down to 2.
Yeah, some of the trainings that I've attended, you'll hear the phrase disaggregate and disclose. That's really the basis around this, that we want to disaggregate your assets, net assets, between those that have donor restrictions and those that do not. Yeah. That's step 1. Step 2 is you got to tell the story behind each of those, and that happens typically in the footnotes, and we'll talk about that shortly.
I'm going to have to get used to, too. You'll see in here that with the donor restrictions, they used to be permanently restricted, that category. They're now restricted in perpetuity. So I'm going to have to get used to that word with the perpetual restriction and in perpetuity. So that's pretty new. So in terms of the enhanced disclosures, as Jim had mentioned, so you'll need to disclose the board-imposed limits. So any board-designated items, some organizations put them on the face, even though they are without donor restrictions. You'll still have to show them either on the face or in a footnote. So what is the board designating for special purposes? The composition of the net assets with donor or grantor restrictions. So that will be the categories of with donor restrictions, and then how those items with donor restrictions can be used and when they can be used, the purpose, the time, and whether they're perpetual in nature, the restriction, or not.
Yeah, that last bullet point on this slide highlight how restrictions impact the use of available resources. Key theme here within this new standard is around liquidity and availability of resources, and we'll talk about those requirements here briefly, but net assets certainly play into that, and if there are restrictions on what resources can and cannot be used, those also have to be disclosed as well.
So the last point we really want to make for net asset classification will segue us nicely into our investment discussion is if you have endowment funds, yay, good for you. That's exciting. Hopefully you don't have any that are underwater because it does change the way you present them. And underwater is when, say, a donor gives you a $100,000 gift and you can never use it and you go and put that into investments in the market and it drops to a value of $95,000. So now you're $5,000 underwater on those investments, and that will have to be broken out separately within your net asset categories on the face of your financial statements or in the footnote.
Yeah, and the FASB really wanted to provide consistency around that treatment, Janice. Sometimes organizations would include that underwater portion as unrestricted. Sometimes they put it as temporarily restricted because it was tied to market fluctuations. Sometimes they put it in permanently. And there's different laws around that depending on what state you're in. I know most people on this webinar are from Pennsylvania, but Pennsylvania is unique in the way it accounts for endowment endowment funds outside the rest of the 49 states. So there's a lot of inconsistency in the current practice, and the FASB is really aiming to provide that consistent disclosure of underwater endowment funds and include that with donor restrictions.
Yeah. So I think the clarity in this area is good.
Yeah, absolutely.
And of course, as you will hear throughout this webinar, additional disclosures about that information. So what is your policy for spending your endowment? The interpretation of the law, like you said, Pennsylvania law is different than what the 49 other states follow. Fair values of funds, the original gift, and the level that you have to maintain. So there will be more disclosures. You may already have some of these, but there will be more required.
So the second main area is investment return. And what the FASB has included in the ASU for this area is presenting all expenses related to investments net of the investment return itself, putting it on one line on the statement of activities, your investment return. Again, trying to be very consistent from one organization to the next. You can easily see how one organization's investment performance is compared to another. It eliminates the requirement that you currently have to disclose the various components of investment income and the expenses separately. So it's a way to put things all together onto one line and, like I said, be more comparable across all organizations.
This one's really interesting because if you look at a set of financial statements right now, you'll see interest income, dividend income. That's generally one line. You'll see realized gain on investments, unrealized gain on investments. These are in all different places. And then your investment expenses, if they're directly related to those investments and those funds and being charged directly by your broker, they're netted in that unrealized gain. And if they're separate, like your internal costs, they're probably in your G&A expenses or in your salaries and comp. And so they're really in a number of places. And this is going to require remapping all of those accounts and actually figuring out if you have someone that spends 25% of their time overseeing your investments, what are you actually paying them and capturing those costs on the right line?
What is your true return? That's really what they're getting at there. Absolutely.
And consistency.
Yep. So with that, we mentioned direct expenses, but there's also certain internal expenses that Janice alluded to that are also included in that netting of investment return. Those internal expenses are those expenses that are the direct conduct or direct supervision of strategic and tactical activities involved in generating investment return. Now, I did not write that. That came right out of the FASB, so I'm not that great with words. But what it means is somebody has to be directly involved in the management of the strategic direction of the investment return. So think of things like salaries and related expenses of staff whose primary responsibility or have primary responsibility for execution of investment strategy. The last comment there, programmatic investments are excluded. So as part of your program, if you have investments that are set aside for the operation of a program, those are excluded from this treatment.
The one positive thing with this is they were going to have you break out all those different lines in a footnote, including your internal costs, which there was a lot of concern if you had one person that manages your investments that you were going to be disclosing their salary in your footnotes. So luckily they have eliminated that, and you just need to make sure you capture them all on one line.
Yep.
On to functional expenses. So in our high-level overview, this is the third area we're going to talk about. So this now requires all non-for-profit organizations to present expenses by both natural and functional classifications. And you're required to present them in one location. But the thing you can no longer do, some organizations were throwing their statement of functional expenses as a supplemental schedule to their financial statements. That can no longer be done. So it either has to be broken out within the statement of activities, and we'll show you that when we convert the statements, in a separate statement. So right after your statement of activities or statement of changes in net assets, you can have a statement of functional expenses, or within a footnote. Now, the one big thing is healthcare organizations, a lot of them had a very simple footnote that was potentially 2 or 3 lines. So program, management in general, and fundraising. If they even had fundraising, they don't all have that. And it was a very simple, 2-line table that tied out to the face of your statement of activities. That is no longer acceptable. So for some of the healthcare organizations, they're going to have these big tables and large breakouts that they've never had before.
Back to that very first bullet point, you can see on your screen underlined and in red, all nonprofit organizations. Currently, this is a requirement for voluntary health and welfare organizations, and that definition is very confusing. Am I really a voluntary health and welfare organization? What is that? It's not tied to any type of easily determinable amount or criteria. So now it takes away that question. All nonprofits have to go by this.
And in a lot of ways, that's a good thing,
It is.
because trying to
Yeah.
figure out that definition and if you met it or not, most organizations just disclosed it.
Correct.
So here is an example of your functional expenses, and we kind of took this right out of a statement of activities where you can show your program services, and that's your functional classification, and then show your natural classifications right under that. So service expenses, salaries, benefits, and then you have your management and general bucket, and you also have your fundraising bucket. And this is one of the three methods of presenting it. And the FASB does expect, when I went to that training, that most organizations, other than healthcare organizations, because it would get way too complicated, to present this right on the face of the statement of activities. Mm-hmm. But the other thing is, a lot of organizations may have 2 or 3 major programs, not just one. Generally, they said if you have more than 3, that's probably too many buckets for this.
Kind of matches up with the 990 as well, disclosing your 3 major program service accomplishments.
Mm-hmm. So you might have 2 major programs and then an all other.
Right.
So you can definitely have more than one bucket of program services. You could have 1, 2, or 3 potentially on how you break that up. But this is what it looks like, and you'll see these exact same numbers in more detail as we show you some of your options. So also with the functional expenses, for the first time, you're going to have to include a paragraph that explains how you're allocating those costs between your program and your support functions, so your program management and general and your fundraising expenses. So you have to not only allocate them and come up with a consistent methodology that you're applying each year, you have to document that methodology, and then you have to make sure you're able to clearly disclose that. So you'll see our example's pretty simple, but I've seen some much more lengthy ones. But it also goes through, you have to think of things like your IT costs. So for organizations that aren't doing this, or maybe aren't doing it precisely enough, as it's going to get scrutinized a lot more under these standards, how are you spreading your IT costs across your program management in general and fundraising? Because presumably fundraising is using some of your technology as well. Your CEO. You're going to have to spread their costs as well across those categories, as well as your CFO. And your CFO, if you don't have someone managing your investments, your CFO is probably doing that. So there's maybe a portion of their salaries that need to go into those investment expenses and investment return, which then would not be
exactly
part
I
of
want
it.
to make sure we have that point made, that you see management in general and investment expenses. So the investment expense of the CFO would be not included in your functional expense breakout.
Right, a portion of their salary. Which is very different, because you want all those numbers to tie.
Yep.
And in this case, it wouldn't, because it'll be netted up in your investment return.
Exactly.
HR, generally that's all management in general. There could be some exceptions to that, but for the most part, and then grant accounting and reporting. So sometimes that's program, but if you're truly writing a grant, if you're writing a grant, you're probably more likely into the fundraising.
Right. And if you're providing a report of operations and accomplishments of a program, that goes into the program versus strictly a financial result. So I'm kind of scared to go to the next slide, Janice, because
Jim knows I'm going to test him here. So I threw these in here. So let's see how well Jim can do, just to point out that it's not always as straightforward as you think it may be, and you may not have thought of all these things. So Jim, where would the salary of an administrative assistant go? Is that program management in general, fundraising? You got 3 choices.
Yeah, I think naturally I would go towards management in general as my first option, but I think there's an opportunity if that administrative assistant is also providing program support, which is often the case in a nonprofit organization where you have shared responsibilities, limited staff who are doing multiple tasks. If that administrative assistant is really helping the function and operation of a program, it would make sense to put some of his or her time there.
Or if they're directly helping your fundraisers, your development department.
Too, absolutely.
So that's a tricky one. So good job, Jim. Yep. So cost of designing, printing, and mailing the annual report.
To me, that is management in general as well. It does not serve any program role as far as the operation and moving forward of a mission. It's a general and admin activity in my mind.
The cost of the audit. What about those professional fees, Jim?
My favorite expense, that is strictly a management and general expense of operating the nonprofit organization.
The salary of your development director.
Assuming the development director is doing nothing but development, that would be a fundraising activity.
Salary of a grant writer who solicits restricted contributions for program activities.
So this is kind of expounding on the one right above it where the grant writer is soliciting. That solicitation expense and what they're using there would be to fundraising.
Absolutely.
Do you agree with that?
I do agree with that, but it did make me pause when you say they're soliciting funds for program activities.
Yeah.
That almost sounds like program, but no, it's absolutely fundraising. You're right. And rent of the office facility.
That's a case where you would allocate towards all categories. You're able to use square footage as your basis there and put some towards programs, some towards management in general, and some towards fundraising.
The other one that makes me think of is depreciation expense. So you really need that depreciation expense allocated as well. So you've got to think about that.
Yeah, that would generally follow your rent or other building costs as well.
I know some organizations would exclude depreciation, or I see that kind of below the line or outside of operations on some financial statements. And this standard is very clear that should not be done, and that your depreciation expenses need to be part of all your functional expenses and be allocated. So if you're not doing that, that will be a pretty significant change. So, Jim, the last two topics until we get to the conversion. So no pressure.
This is where I want everybody to kind of pat themselves on the back and say, great job being in the nonprofit sector, because we are leading the charge here from a FASB perspective. And
I don't think they signed up for that.
Well, I'm patting myself on the back. Liquidity and availability resources. First time that the FASB is requiring for non-public entities to disclose certain things that have never been disclosed before. I think of it, as I mentioned earlier, as another way for a nonprofit organization to tell its story and really assist readers in understanding how an organization operates and its ability to operate on a go-forward basis, what type of resources are available, how they manage liquidity, and its related risk. The disclosure requirements for this fall into two buckets, quantitative and qualitative. Quantitatively, you have to disclose the financial assets of the organization as of the date of the statement of financial position. So as of 6/30 or as of 12/31, what financial assets are available? You have to consider whether those financial assets are affected by things such as external limits from a donor, from a funder, from somebody, or internal risk. Has the board set aside a amount that they want to use for specific purpose, board designations? Those impact the amount of financial assets that are available. Qualitatively, you have to disclose how you manage those resources to meet your cash needs within 1 year. Things such as putting cash into a reserve. Has the board designated certain amounts for rainy day funds? Do you have a line of credit available with a bank to serve that? All that needs to be included in that qualitative disclosure. And we have examples to show you here in just a couple minutes.
I can tell you, Jim, there's a lot more to this than I realized. And going through, we have a very simple example, but it will just help you understand it. But the complex spreadsheets, this liquidity disclosure in the table really ties together just about every number that is somewhere shown on your financial statements, to anything with restrictions, you can even be adjusting your cash balance, as you'll see in our example, because you can't access that because it has restrictions on it and things of that nature. It's very interesting how this ties all of your statements together, and I didn't understand that when I initially read it.
And for those organizations with a lot of restrictions, a lot of designations, there's going to be a lot of time and effort to get this disclosure to be accurate and correct. I was consulting with another organization not that long ago, and for whatever reason, they decided to early adopt the standard. I'm not sure that would be my recommendation, but very easily they missed the qualitative disclosure.
So they missed the paragraph.
They completely missed it. They completely missed it. And put a nice table regarding financial assets, but missed that qualitative disclosure. So that's definitely a requirement that has to be met. Go to the next slide, which is a statement of cash flows in that last area. Here, the FASB is kind of not really patting us on the back, but kind of giving us that option to tell our story a little bit better. They're giving us, as the nonprofit organizations and community, the option to choose between the direct and indirect method of reporting operating cash flows. For those of you that know the direct method, you probably studied it back in school. It's not used as frequently as the indirect method, and we'll walk through what that example looks like in just a couple minutes. But in short, if you do elect the direct method, which is oftentimes preferred by donors and users of the financial statements, but a burden upon the accounting department to put together, you are no longer required to also include the indirect method reconciliation as it's currently stated in the standards.
Great. Thanks, Jim. So we're right about halfway through, or not quite halfway, so we're good on time. And this is where we wanted to spend the majority of our time, which converting your financial statements. So as we said, this is a pretty simple set of nonprofit financial statements, but we are going to walk you through starting with the statement of financial position. So this is the current presentation that you're using. We're very generic ABC company. So we see their assets, liabilities, and net assets. And I want you to pay particular attention to the net assets section where we have unrestricted net assets, temporarily restricted, and permanently restricted net assets. And just keep in the back of your mind that $49,000 of permanently restricted net assets because it's going to come up later in the liquidity disclosure. And that's the only place you'll see it in the new presentation of the financial statements. So if we go to the next slide, the exact same schedule where your assets and your liabilities stay the same, but the section at the bottom for your net assets changes. Now you have a couple of options here. One option is just show a line without donor restrictions and that $1,385,000 total, and then with donor restrictions and that $589,000 total, and bring it down. And then you put all that information that we have on the face in a footnote. They are expecting that a lot of healthcare organizations will put this in a footnote because their financial statements tend to be more complex than other nonprofits, but you'll have to see if you have a lot of investments, endowments, assets whose use is limited, perpetual, investment, beneficial interest in perpetual trusts and things of that nature, and you have a very complicated statement of financial position, you may not want to put it on the face, but you do have to disclose this somewhere.
Yeah, I think what we have on this example where there's about 3 categories underneath each of them is probably the max that I would recommend if I was being asked what I would like to see. Otherwise, it can get very complicated on the face of the financial statements, and that information is probably easier for the reader to digest in the footnotes itself.
And you're going to have to make materiality calls because if you look at the time restriction for future periods, if you go back to the previous page, we have $49,000 of permanently restricted there, and then we have a piece in temporarily restricted. So if you flip over to the $89,000 that we're showing there, depending on materiality, you may need to break that out, because that's time restricted for future periods. So a piece of that is time restricted forever, and another piece can be used. So just to point that out, you're going to have to look at the materiality of these different buckets and how far you have to break them down.
So as you're sitting here today, what should you be thinking about from an organizational standpoint? I think you should be taking inventory of all those designations that you have and trying to determine what level is going to be appropriate once you do implement this new standard. So if you do have a lot of those designations, be thinking about what that's going to look like on your financial statements. In addition, if you have a lot of board designated amounts that have historically been there, this is a great opportunity to get the board involved and think about, do those restrictions really continue to make sense for where my organization is today? Do they need to be modified and changed, updated, formally documented? There's a lot of things to think about and really have your board get involved in that conversation. And
you have to prepare the board for that conversation because if they should change some of their designations or change some of the things they've done, you have to do that before your year end so that you can reflect it properly on your year-end statements.
And to kind of tie everything all back together to liquidity and disclosure, all those decisions are going to impact those financial assets and qualitative disclosures we talked about.
Absolutely. And you want to know if you're going to end up, we'll show you the disclosure, but some organizations can end up with negative liquidity, and you're going to want the board to release some of those funds ahead of time so you don't have to show that.
I'm just an accountant, but I don't think that's a good idea to have negative liquidity.
It's really not. So here's the next statement. As you can see, we're going to walk right through is your statement of activities. So it follows right after your statement of financial position. So you see here your 3 columns, which is how most organizations present it. Healthcare organizations present them linearly or the pancake method.
The pancake method is my favorite method.
So they present them in a row, but it's the same information. And here you have your 3 columns, unrestricted, temporarily restricted, and permanently restricted, and you're showing both years. As we go to the next page, these are the changes you're going to see. So I highlight a couple of things. Your permanently restricted and temporarily restricted columns are really going to collapse into one. So those numbers have changed, and they will be the with donor restrictions column. And you will see that you will only have 2 columns and a total. So that's a pretty significant change there. And the other thing I want to point out is the income from investments line. So that's where you're going to capture all of those costs on one line. So whether you have income or you have losses, in this case, I think it's just interest because they really don't have investments and the cost to kind of monitor that and the net of all of that. So they're all going to go on one line right there. So if we go back one more time, you go from the 3 columns to the 2 columns, and I highlight the income from investments to make sure you're doing that properly.
So what are some things to think about as you're sitting here today in June? Is your general ledger set up in a way that it can capture that information, Janice? You think about the income from investments and related expenses that need to be netted there. Is your general ledger set up that way to capture those expenses? Do we need to potentially change some account structures to comply with the with and without requirements? All things to be thinking about as you get into your year ends.
I certainly believe you will, but I also think a lot of organizations, when it comes to all those buckets of net assets, where you now may have like 8 or 10 or 12 different buckets of net assets, you had them before, but a lot of smaller organizations are capturing them in Excel. I think it's a good time to step back and evaluate, is Excel the best method? Do we want to try to use our ledger? Like, how do we want to go about making sure we're capturing the right data?
Right.
And that's going to take some time to say what's going to make the most sense going forward, as opposed to getting to your year end and trying to convert it retroactively and think about it after the fact. That's going to be a lot harder.
Right.
So this was another option for the statement of activities. So I took from the previous page where we would have already collapsed the with donor restriction columns into one column instead of 2. And then I'm showing you one of your options for functional and natural classification on the face of the financial statements. So this is where you would be able to break out your program service expenses, your management and general expenses, and your fundraising expenses right on the face. This is an option. What we showed on the previous page is also an option, which is just the natural classification, and then you need a separate schedule or a footnote to show your functional expenses. This is one of your 3 choices to put it on the face. So you'll have to decide, how busy is this schedule? How much information do you have there? And how does this make sense for your organization? But what you will see here within those expenses is you will see depreciation showing up both within program services as well as in management in general. It will be considered a red flag to only have depreciation in one of those buckets.
Correct. And likewise, you're going to see salaries and other categories in multiple areas of this statement. So it's not as easy to look at and say, what are my total salaries expenses of this organization? I'm going to have to do a little bit of math or supplement it with a statement of functional expenses.
Well, that's if you choose to present it in this format.
Correct.
So again, you've got to make
choice.
some choices about what makes the most sense for your organization and the users of your financial statements. Because if we go to the very next slide, if you want to make it its own schedule to keep the face of your statement of activities a lot simpler, you can show it in this format, and you can have 2 or 3 or even more program service columns explaining what each of your major programs are, and then show, so you have a total of salaries and you see how that's allocated across the buckets.
Yeah.
So, and you can see how the depreciation is being allocated there, as well as a lot of the other costs. So as you can see, there are 3 options, all perfectly acceptable, but management has to make this election of what makes sense for them on the face of the statement of activities, in a separate statement or in a footnote. If you weren't doing this, you got a lot of work to do.
Yeah.
And if it was a supplemental schedule, you definitely have to move it.
And if you weren't doing it, hopefully you were doing it when you did your 990. Because
you do have to do it in your 990. That is absolutely true.
This does look very similar to the 990 and the allocation that's done. So I think a lot of organizations, as the FASB has recommended, will put it on the statement of or schedule or statement of activities, but also might supplement it with something like this to kind of match the 990. What are some things to be thinking about? Are you documented and have you developed that allocation plan to make sure that you understand what is going to each of those buckets and how to allocate some of the things that Janice and I talked about a few minutes ago? Make sure you're doing that kind of stuff now before you get to year end.
Yeah, and we will show you a footnote, but there is an expectation that if you have service expenses, salaries, employee benefits, payroll taxes, that in your footnote, you're going to address each one of those and how you're allocating that.
Yeah, it's not a simple one sentence disclosure that
No,
a lot of us are used to seeing, that activities are allocated amongst program.
Now you could say salaries, employee benefits, and payroll taxes are allocated based upon an estimate of the actual time spent relative to their total compensation.
Correct. Yep.
So there could be a few that you get to bucket together, but there is an expectation that you will address every single one of those lines. And I know the statement of functional expenses I see now, there's on average probably 20 lines.
Yeah, 15,
Not
20.
as simple as this.
Yeah.
So the disclosure could get pretty lengthy. Again, this is a simple disclosure to help you understand it, but it could get pretty lengthy. So as we move on to the statement of cash flows, I really just took the operating activities in the cash flow here. So this is the indirect method that most of you are probably using. I just showed 1 year. So the current presentation is the indirect method. You may continue to do this. However, they are cautioning you when you adopt this standard, have you thought through what is most beneficial to the users of your financial statements? So your other option on the next page is to present cash flow from operating activities, which aligns more with, the money you've received and where you've paid things. Now, there are ways to set this up pretty quickly where you pick up your expense and back out your accruals or receivables. There are ways to set this up formulaically, but you should be thinking about what is most beneficial to the users of your financial statements.
Again, thinking about telling the story, the cash flow statement can tell the story of an organization's year very easily to somebody picking up the statements for the first time. If you look at the direct method on the screen here, it to me, it's very understandable how much contributions that I receive. It takes away the accrual adjustments that Janice mentions. How much did I actually pay for telephone expenses? How much did I actually pay for special events? That's clearly on this direct method. It's a lot more work for the accounting department and the fiscal team to pull it together, but like you said, it could really help your donors and people who use the financial statements.
Yeah, it's something that needs to be considered. So if you aren't getting that theme yet, that there's a lot of decisions that management needs to make about what's in the best interest of the organization, you should be starting to have that sink in. Like, I need to make some choices here about how I want to present this information and how I, as Jim says, tell my story. So the next couple areas, we are not walking through every single footnote. We're just going to walk through the significant footnotes that we know are changing. The only exception to that is underwater endowments. So if you have those, we're happy to work through them with you, but they can get very complicated and time consuming. And in the interest of 50 minutes, we wanted to focus on the things that we knew affected everyone.
And Janice and I hope none of you have underwater
endowments. That's true. Yes. So the current presentation is within your significant accounting policies. So for most of you, that's probably either footnote 1 or footnote 2 to your financial statements. You will be disclosing the net assets under the permanently restricted, temporarily restricted, and unrestricted categories. So you probably have something very similar to this in your footnotes. And if we walk forward to how that's going to change, so we're going to be talking about the net assets and how they're calculated, and we're going to describe the net assets without donor restrictions, and then the net assets with donor restrictions. And the one thing I highlighted there is the resources to be maintained in perpetuity. I really want to get used to that new word. The other thing to note is any time throughout your financial statements where you used to refer to unrestricted, temporarily restricted, and permanently restricted, you now need to change to this terminology because that old terminology is gone and is completely going away. So you have to really think through every place you need to change the without donor restrictions and with donor restrictions.
You'll be surprised how often those terms show up in your notes. Again, I consulted with an organization a little while ago. They made the election to early adopt. They changed footnote number 1, and I thought it looked great. And it did look great. But the problem was there were 34 other pages behind that needed to be updated as well. So within an endowment disclosure, within a net asset disclosure itself, those also had to be updated as well.
Yeah, so there's a lot of little pieces to that. So here is the example. The length of that, it's about the same as it was before. This may be one area where it's actually a tiny bit shorter because you only have to disclose 2 instead of 3. But keep in mind that policy will need to be updated. So if we move on to the next page, as we're changing these buckets from the temporarily restricted and permanently restricted, we're going to without donor restricted. That would be considered a lot of reclassifications on your financial statements and within your net assets. So you should have this disclosure about reclassifications in the year of adoption. So that will be within your policies footnote, again, footnote 1 or 2, depending on how your statements are structured. And then you will also need a recently adopted accounting standard. So you will need, every organization would need to look at this and say, hey, we've adopted this new standard and here's the big things that have changed. We've also noted here that this organization actually had underwater endowment funds, and we wanted to show you that given the materiality of that and how you may be changing the classification of that underwater portion, you may need to disclose that here as well. So that's certainly not going to apply to everyone, but 3/4 of that paragraph will.
Yeah, any type of material reclassification, like you said, would need to be included in this footnote.
Yeah, and depending, it's very likely you may have an emphasis of a matter paragraph in your opinion.
That's a good point too, yes.
So you might see an extra item in your opinion to say, hey, we've adopted this new standard. That's pretty standard, nothing to be concerned about, but we do have to highlight that to the reader. The next one is the functional expenses. So this actually takes the schedule that we had shown before in a couple different options, whether you present it within your statement of activities, within a separate statement, or within a footnote. If you put it within a footnote, you will put that table right here. And if you don't, you can, and then put the paragraph underneath explaining it. If you can look at that table in line with this, we actually walk through about each of the expenses. So depreciation, executive salaries and benefits, administrative and professional fees, and supplies expense. So we kept this very simple. They only have like those 6 categories. And then we tell you depreciation is allocated based on a square footage basis. Executive salaries and benefits are allocated based upon estimates of the actual time and effort. Administrative and professional fees are allocated based upon the benefit received, and supplies are allocated based upon estimates of specific usage of supplies.
So I'm going to put you on the spot here, Janice. As a rule of thumb, should every expense line be disclosed here as far as the allocation method, or would you consider somehow grouping them together or calling out more material ones? What are your thoughts on that?
Absolutely, the material ones should be, but you can even see here in this example, executive salaries and benefits. That included payroll taxes, that includes their benefits. There's actually 3 things in that line. So absolutely, to the extent they're consistently done, you want to group them, but it would be required that any material expense is addressed here. You're going to have to make a materiality call. If you have $5,000 on that schedule, is it worth allocating? And you maybe didn't really allocate it depending on what it is. If it's printing materials for fundraising, you didn't allocate it at all. But you should be thinking that you have to address every line of that statement of functional expenses unless it's clearly immaterial.
I agree with you. I agree.
So the question we pose here to everyone on this webinar is, does your organization currently have the detailed methodology in place that this disclosure will require? Can you say, most organizations have a methodology. We audit the spreadsheets. We know that it's there. But can you clearly and succinctly say, this is our methodology and this is how it applies to that spreadsheet? And for organizations that don't even have the spreadsheet, that haven't really done this, this is going to be a pretty big change. A lot of time and effort. Yeah. And I wrote in my notes here, is that methodology documented? Because you're going to get asked for it as part of the audit. It's your auditor. We're going to say, so how did you do this? So where'd you write that down? Or do we need to sit down and sketch this out? Because we need you to give us something on how you're doing. So we can talk through it, but management has to have thought this through. As we continue to what else is new, so I just showed you the new presentation here, and this is actually 2 pages. If your net asset detail, if you do not want to present it on the face of your statement of financial position, you may put it in a footnote, and this is what it would look like in a footnote. Again, a very simple example. So you would disclose here net assets without donor restrictions are comprised of the following, and then you would show those details. This looks exactly like what we showed you on the face. You just have an option to put it on the face or within a footnote, but you have to have this information.
Absolutely. Some of you have probably seen me present on this topic before, and you can remember some of the examples I used. This note can get very, very lengthy the more
Absolutely.
Yeah, it may fill 1 to 2 pages potentially, depending on the amount of designations and restrictions that your organization may or may not have.
I mean, our example is only a $2 million balance sheet. So.
Right. And I'm going to make this comment again. Remember the impact that this could have on liquidity and availability of resources. Mm-hmm. That's all going to have to tie together at the end.
Mm-hmm. So this is kind of the first part. It was too much for us to put on one page for the without donor restrictions. And on the next page is where you would disclose your with donor restrictions. Mm-hmm. So again, we show there the underwater endowments in the previous year, because these would be comparative, and how they have to show up in the with donor restriction category.
Yep. And those same restrictions that you had before, whether that's purpose or time restricted, we always talked about how that fits the bucket of temp restricted net assets. They still remain. They're not going away. I just want to make that point very clear. Those restrictions are unchanged. That's just where they fall on the financial statements, and the disclosures around them has changed.
Great. So net assets. The interesting one. So liquidity. I have to be honest, when I first read this and I read the standard and I was like, oh, liquidity. So you pull your cash and your AR off the face of the financials. Investments, sure. You can choose to back out liabilities and come down to a certain number. That's required if you have underwater endowments, by the way, to show that. And I was like, well, how hard can that be? And then I started looking at some of the examples. So in this example, our cash on the face of our balance sheet is $1.4 million. We don't have any investments in this simple example of financial statements that we've showed you, but we had $49,000 worth of, under the old terms, permanently restricted funds, or those restricted in perpetuity under the new terminology. And we have to back that out of our cash because we don't have investments to cover that. When you start to think about beneficial interest in trust, if you've done a capital campaign for a building, if you have pledges receivable that have current and non-current portions, the non-current portions have to be backed out. If you have board designated funds, they have to be backed out. If you don't have investments to cover that, you have to back it out of your cash. And there's a lot of guidance out there about what do you do if you do have underwater endowment funds and the board has designated too many funds and you actually don't have the financial assets available. Like, what do you do if this becomes negative? And there's a whole bunch of additional disclosures and footnotes, and you better hope you have lines of credit you can draw on if this is negative, because it's really not acceptable for it to be negative, but it could happen at certain points in time. So the table is really important. This is an incredibly simple example, but you should expect that you're going to have spreadsheets and calculations that back this up. That's going to tie together restrictions from your net assets. It's going to tie together your endowments, and you may have $13 million endowment fund, but you may be only able to spend 3% of that or 4% of that a year. So that is the only amount available to you to spend in the next year. And you have to be looking at it that way. So this can get incredibly complex. So please do not dismiss it. I was a little bit surprised at the number of examples out there and the complexity. When
I first saw this, I thought, they're just asking for an additional disclosure around current assets. It's not just current assets; it's financial assets. That's a new term that is now defined. It's different than current assets. So if you are presenting a classified financial statement, it's not as easy as just taking the amount of current assets that you have on.
Because prepaids are specifically excluded; they're absolutely not a financial asset, and none of your fixed assets are as well. And
it's a lot more complicated than we originally thought it was going to be.
And your endowments are not necessarily financial assets unless they're liquid and they're not restricted in any way, which is typically not the case. So, and then also don't forget that you have to disclose like your liquidity management and how you structure things and your expenses. And then also disclose that will tie together if you have a line of credit or other resources you can draw upon that are disclosed somewhere else in your financial statements. You'll be highlighting them here and cross-referencing those notes. So
that first sentence there, as part of ABC Company's liquidity management, it has a policy to structure its financial assets.
Does anyone have a policy?
Who has that policy so far? You need to have that policy in place.
And generally, that's something you should think about your board taking a look at, because if you're going to have a policy and disclose publicly that your definition of financial assets meets the definition in accordance with the FASB, like you need to be thinking about that. So I hope this has been helpful to show you old to new. I know the last few footnotes are all new. There's not a lot of old. So I'm just going to turn it over to Jim to as if we haven't said enough, but the actions you should take now.
So we're sitting here at what's about 250, Dan?
End of June.
End of June, yeah. So if you do have questions, here's a good time to start to send those in to us. I would like to take some. I haven't gotten any score updates, so that's probably a good thing.
You've been focused.
I've been focused here. So if we can go to the next slide there, Dan, that'd be great. And you're also giving me some questions. That's great. So a couple of actions to take now. We mentioned it earlier. Spend time to actually read the ASU. There's some great resources out there on the FASB's website that take the ASU, which is very long and makes it very simple to read. Identify members of the management team that will lead the implementation. Often this is going to fall on the burden of the CFO or the controller, but there's going to be other members who are going to need to play a critical role in that, whether that's the CFO, executive director, people within the fundraising area, to help lead the different areas of the implementation. Ensure all individuals have training, things like attending webinars like today, some self-study material that's out there. Make all the stakeholders understand those changes. Prepare those stakeholders as well, the board, donors, and lenders.
I mean, with that, preparing your stakeholders, make sure you're preparing yourself. Like if you're the CFO, you're the controller, are you actually making these decisions about all the options that you have, and do you have the policies in place and the allocation methodologies documented and the information available? So there's definitely a lot to think about here.
Discuss the impact of changes with your accountants and your auditors. Again, lots of things to take into consideration. Is this going to impact the timing of my audit? Who's going to be responsible for doing some of these things? Oftentimes, accountants and auditors prepare the financial statements. Is this something that management might want to take over and try the first time, make those changes, and then give them to the auditors, or are they just going to delegate that to the accountants to do?
Well, you can't just delegate.
You can't just delegate it. That's
There's
true.
a lot of decisions. Auditors can help,
Yep.
and we can guide you through it, and we can help prepare schedules. But there's choices and policies that management has to make
That's a great
about
point.
What makes the most sense for their organization.
And a best practice that I've seen in place is applying the provisions to your most recently issued, your last audited financial statement, to kind of set the stage for what it's going to look like when it does have to go live.
I'm definitely recommending that. I wish a lot more organizations were doing that, because you're going to have to convert them anyway. It's not double the work to convert last year's and this year's. You're going to convert last year's and then have it all set up and ready to go.
Excellent.
This is our last slide, and we got a couple of questions, which is exciting. We like that. And Jim, you got your score.
I know. Well,
but at least
I have
it
to thank
didn't distract you while you were presenting.
Bill's telling me that it's still 0-0, but that was about 24 minutes ago. So, Bill, if you're still there, if you could put your score update in, then that'd be awesome. We already went over the effective dates, which are coming up very fast for a lot of organizations: 12/31/18, or more commonly 6/30/19. Comment regarding transition. In that year of adoption, you have to apply all the provisions of the ASU. You can't pick and choose which ones you're going to apply. So if you did early adopt, you have to do them all. For any comparative information that's presented, you can choose not to present the expense by nature and function, unless you are already required to do so. And also those liquidity disclosures only have to be included for that first year that you're presenting financial results. And as Janice mentioned, disclose any reclassifications or restatements in that year as well. So with that, we're going to go to questions.
Yeah, we have some good questions. I wanted to jump in there because I'm going to ask Jim the questions, right? Are you ready, Jim?
All right, still 0-0.
Do you
thank you, Bill.
think the IRS Form 990 will change?
I hope so. Do I think so? It needs to. It's needed to actually for a few years. The AICPA did write a letter to the IRS back in August of 2017 requesting that the 990 form is updated to comply with this new standard. It's actually not been updated for a few years and still refers to things such as A133. So in the nonprofit world, we changed that to uniform guidance. So there's multiple changes that are needed. I'm hopeful it gets done. What they are recommending, if it is not updated for 2018, is that you follow the same transition guidance that's included within the ASU itself, and do your best to disclose according to the new categories. Net assets is probably the biggest change that's going to impact the 990.
So you kind of have to take the new presentation and fit it back into the old form until they get around to updating that.
Yeah. So hopefully that doesn't happen, but it could.
Great. So another question, what if your nonprofit organization files cash basis financials or modified cash basis financials?
Well, am I answering this one?
Sure.
All right.
You're already started. Go right ahead.
Sorry. A purely cash basis statement, there's not going to be a lot of impact because that's just one statement, right? And remember, cash basis is not GAAP. So we have to keep that in mind. So a purely cash basis statement is only one page. A modified cash basis statement will have to imply a lot of the changes that GAAP is requiring. It specifically states that within the review and comp standards that cash basis statements would follow GAAP. So you would do things like change net asset terms to with and without donor restrictions. If footnotes are included, they may or may not be. You would have to then comply with the
footnote
requirements. Right.
Yeah. Yeah, that can be very challenging because you're usually doing the modified cash basis to have something quick and easy and easily understandable, and now you may have all these new footnote requirements.
Absolutely.
So it looks like we are right about on time. We were able to address most of the questions that we have received. So if anything, we hope we've given you a lot to think about, a lot for your organization to consider, the policies you need to do, the choices you get to make as you go through and implement this standard. And we're certainly here if you have any questions or concerns as you start to work through that. Thanks, Jim.
Thank you for your time, everybody.
Thank you once again for joining us for this webinar recap produced by McKonly Asbury. We hope you join us for all of our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting www.macpas.com. Thanks again and have a great day.